welcome back. Robust, that's how Invicta has described its half-year results, even against a backdrop of volatile currencies and an uncertain global environment. The firms posted a 12% increase in revenue, while net profit grew 8%. CEO Steven Joffe joins us now for more insight on those numbers. Thank you so much for your time today, Steven. Now, let's start us off with you framing the performance of your operations and also how you've managed your working capital in this period.
Well, so let's start with the general environment. Very, very tough general environment, and choppy not only in South Africa, in every jurisdiction in which we trade.
Yeah.
With higher interest rates, people that hold inventory, they're trying to reduce their inventory holdings to help with their interest costs. And you've seen that play out in every single market that we operate. And typically we supply the wholesalers. So that's very much where we play. And the net effect is people hold back on orders as much as they can. That's the environment. Then you've got currency volatility happening everywhere.
Yeah.
And then many challenges in supply chain coming on the back of COVID. Yeah. And in South Africa, then you've got the enhanced challenges of the ports and things like load shedding and water outages. So that's the general environment. And specifically in our case, interest rates had an impact of about 25 million rand year on year in our results. So if you took away the interest impacts, we were very pleased by how we performed. And with the interest rate impacts, we'll end up with robust.
Yeah. Well, I mean, yeah. And actually, how does that then filter through to your working capital requirements?
So in South Africa, everything you buy is probably 10% more expensive than it was a year ago.
Yeah.
So you really got to squeeze your working capital to hold the line, which we managed to do. And that's pretty much the result that we managed to put together. Where we've had an increase in working capital in the year, it's because of a new acquisition in the UK.
All right. Well, of course, I understand that you do operate outside of South Africa, and I'm wondering how far your Rand hedge benefits went.
No, we did nicely out of the Rand hedge. I've just looked at it in the last 2 years. We made over 10 million Rand profit, and we've actually closed out the hedge now. So in this year, it was part of the reason why expenditure was up, because we made a gain last year, and this year we had a cost. The net difference was 10 million Rand.
And I mean, your gross profit margin held up. Would you say that you have a firm handle on the dynamic of minimizing costs as much as you can, but also increasing those selling prices?
I think it's a very important part of what we do, and something that as a management team we reflect on a lot. So we really try hard to price appropriately. We don't pass on increases as the Rand goes out. We do it in a much more measured sense. Yeah. But we do try pass on those increases as we need to make sure that we can keep our margins at appropriate levels. Right. It's a big area of focus.
All right. The acquisition of IMEX in the UK became effective in July. How has that contributed to your earnings so far?
So IMEX is going to be a very small contributor in the short term.
Yeah.
When we bought IMEX was going to make about £3 million a year. That's what it did last year. So it's a really small acquisition. But you'll see it's like a 100 million Rand asset because they own their properties, they own a fleet of trucks, they own debtors and working capital. So we took that all over. But the reason we made the acquisition wasn't for IMEX per se.
Yeah.
We've got a very good business in Poland which distributes products. And we think that the UK would be a very good market for those products. But we've been unable to get a staff complement and get that business going. By buying IMEX, all of a sudden we've got a business with lots of staff, with capability, with distribution, with warehousing. And now we're going to start introducing our product mix into that business. And we think that will be quite an interesting opportunity.
Very, very interesting there, yeah, as you do try and get those synergies going. A nice self-help strategy there. In terms of self-help, of course, you have this strategy or this target of making 50% of your earnings from outside South Africa. And I'm wondering, in terms of your asset composition, where you are in terms of reaching that target.
So in assets, we still got the bulk of our assets in South Africa. Net profit-wise, we probably have got there already, but we still have to grow the asset base in these other jurisdictions.
All right. Okay. Very, very interesting there. And I'm actually...
What's crazy, excuse me, what's crazy is the extent of the devaluation of the rand, how quick we got there. We set ourselves a 5 or 6 year target, and I think we got there in 2 years.
Okay. That's actually very, very interesting, and definitely something that we will be keeping a close eye on there. Of course, let's look at shareholder value. And of course, you have been embarking on a share buyback program. And I'm wondering what the runway for that program looks like and what it depends on.
So the first thing and the most important thing is cash generation, right? As long as you're generating cash, you've got opportunity to invest. Then we've got the opportunities to apply our minds how to deploy the cash base. Every single time we make an acquisition, we're always challenged with, should we buy back preference shares, should we buy back ordinary shares, or should we make the acquisition? So this is something routinely on our agenda. And when you're trading at like a discount to NAV like we are, and a low multiple like we are, that will be a routine question until such time as those things are resolved.
All right. And just lastly, as we wrap up the conversation, I think we have about 30 seconds left. Of course, these were interim results, and I'm wondering what we can then look forward to for the second half of the financial year.
So our businesses and our product mixes are resilient. We're in replacement parts business primarily. And because of that, I think we've got a reasonable chance to have a decent 6 months. As I mentioned to you, many of our customers are the distributors, and they've destocked to the extent they can to save interest, but they're now getting back into a cycle where they're going to have to stock up again. And then our one big capital business, our CE business, which does capital equipment, we had a remarkably strong 6 months. They're a remarkably strong management team, and we've actually got a really good order book. So we're looking forward to another 6 good months in that business too.
All right. Well, thank you so much for your time and unpacking those numbers that came out of Invicta earlier on this morning, Stephen. Appreciate it. That was Invicta CEO Steven Joffe.